The Fed Chair Jerome Powell just cut interest rates in September by a half point. And there's a good chance that he's going to cut another half point in November. So, is this a good thing or should we be concerned? Well, in this video, I'm going to show you why I think the stock market is at highs right now and there could be a significant pullback coming. We're going to talk about the best way to take advantage of that so that we're ready and we can make bank. Guys, we've got a great video for you here today. If you appreciate the time and effort that goes into making these videos, go ahead and hit that like and subscribe button down below. Also, be sure and download the free options workshop in the link below. It talks about the two main benefits of trading options over buying stocks. There's also a paid course as well. Disclaimer, I'm not a financial planner and I'm not recommending trades. Please do your own research, and if you're new or learning options, I recommend you start small. Guys, taking a look at the S&P 500, the Fed Greenspan has cut 50 basis points just this last month in September, and there's going to be another 50, it looks like at least a quarter in November. And the market right now, you can see in the last month, we're up 3.36% in the S&P 500. 6 months, we're up almost 10%. Year to date, we're up 20%. And we were up last year, so the market's very high. Over the last year, we're up 33%, and over the last 5 years, almost 100%, 93%. So we can see that the market is really high right now. And is this the best time to be long? I'm going to be careful right now. So what do we think is likely going to happen with the market through the end of this year and into next year? Let's take a look at the monthly Fed funds interest rates through the present day. And you can see right here, back from 2004 to 2006, the Fed raised interest rates from 1.5% up to 5.25%. So this is very similar situation to what we've just done now. And the Fed raised interest rates from quarter point to 5.25 points from 2022 through just recently when we started. I mean, the first cuts came this last September, so we just started cutting. So it's very similar. And look what happened as we raised interest rates and then started to ease rates and lower them. So that's quantitative easing. And as soon as that happened, there was also a recession. It was the housing crash, of course, and the Great Recession of 2007. So from December 2007, and it lasted through June 2009. So what does that tell you? It basically says that the Fed is late to the game most of the time. And the effects of interest rate cuts take basically a year to 18 months to even start taking effect. So from 2007 to 2009, the S&P was basically cut in half. And if we look at that, 2007 to 2009, we've got to look back here. But if we're looking at 2007 right here, look where we were. And then 2009, we were half. So that was a big drop. And look where we are now. This is the max right here on the S&P. We've moved up. And I mean, we could take a big drop if the Fed was late to the game again. And a lot of people right now, like Warren Buffett and the Berkshire Hathaway fund that he has right now, is a lot. They've got a lot sitting in cash, waiting for that pullback. So I think everyone, is, because the market's been at a high, they want to be in. Everybody's greedy and they want to make more. But we've really got to be careful. And where we can really make money is sitting with cash on the sidelines. And then when that drop does come, then we can get back in. Now, at the beginning of the year, many analysts were already saying it was time to sell off your stocks since we were up last year and at highs. However, look what happened. We would have just missed out, if you look year to date, on 20% gains upside this year. So I'm a big, firm believer that we've got to stay in the market, and invest long term. And that's what I do with my 401k and my retirement. And I suggest you do the same. So the money that I'm talking about, that I play with, for option trading and trying to grow that more like a business, is the money that I'm talking about here. And that's where I would take some of that money off the table. And I'm going to talk about where I'm investing it right now. Let's take a look at Schwab US Dividend Equity. It's an ETF. Ticker symbol is SCHD. And I love this ETF. If you look at the 1 year chart, you can see it's moved up pretty steadily. The PE ratio is 16, so very fairly priced. And the best thing is there's a 3.35% yield or dividend. So that's great. If you look at the 5 year, it's very solid as well. And max, it just moves up and it's solid. But when people get out of the market, when the big investors like Berkshire Hathaway and they're sitting in cash, what they'll stay in is the value stocks and the consumer stocks, the dividend paying stocks. And if we look here at the portfolio and what the ETF, what it holds and the sector weightings, you can see it's pretty balanced with financial services, consumer cyclical, consumer defensive, healthcare, all the dividend guys, energy, industrials, and even some tech. And you can see the top 10 holdings here: Lockheed, AbbVie, BlackRock, Coca-Cola, Home Depot, Verizon. I think Verizon pays like a 6%. It's a huge dividend. So great companies, and I really like to play this because the money's got to be invested somewhere. If we look here, perplexity.ai, this is an AI tool. It's kind of like Chat GPT, but I like it better. You just type in a question. Here I typed in, how many all-time highs do we typically get every year in the stock market? And it came up and it talked about different variations by period. But what I was surprised at is there's an average of over 16 new all-time highs every year since 1950. So that, I was unaware of that. But it tells me that, hey, long term, we've got to stay in the market. But again, I think there's times that if we're being an aggressive in an account, specific account, and we're trying to grow that faster than the S&P, then I like to pull and have cash on the sidelines when we are at all-time highs anyway. But my point of this is I think we've always got to be invested at some point in the market going forwards. All right, guys. So if you punch in, this is the Tasty Trade platform. I use Tasty Trade and Moomoo. I've got links down below. Check them out. They're both great for trading options. I punch in SCHD up here on the Tasty Trade platform. I go to the Trade tab here, and actually, you know what? I can just do long stock right here and hit go, and it will give me the mid price. 8 right here, click in the middle, 84.47. You can see that's what it's trading at. So for 100 shares, it would be $8,848 or $8,449. And if we traded that way, you can see, go to the curve mode here on the trade tab, and you can see as the stock price moves up, we continue to make money. And you can see the P&L up here, P&L at expiration, 14.45 we would make on top of what we invested, the 84.47. So as the stock price moves up, we make money. Another way to trade this, so that's what you can do, and you can collect that 3% dividend. If you don't have, you can also on other platforms, you can buy fractional shares, you can buy a smaller amount. You don't have to buy 100 shares, you can buy 1 share for $84. So depending on the platform that you're on. But with this particular platform, if I didn't want to spend $8,447 for 100 shares, another way, and something that I frequently do, is I will utilize leaps options. And a leaps option is just an option that's out over a year. So I go 471 days out, till expiration, which puts us at January 16th, 2026. Open that up, and then I'm going to look at the 80. That's in the money, and that is $9.70, and it's out over a year. So I click on the buy on the call side to buy a call, and I can buy that. The mid price is $8.15. So for $815, I can control that same 100 shares of stock. I don't get the dividend though with options, so that's the downfall. So with SCHD, I'm probably gonna to buy the stock outright so that I can collect that dividend. But just to show you the leaps, if you go to curve mode here, you can see you just need it to move up a little. So from 85 to 87, which you know, as people invest more in this, it's going to go up. But then it moves up just as if owning the stock, just like we saw before when we bought 100 shares. So that's the beauty. You can use much less capital, and you can really use leverage and multiply your money that way if you use a leaps option. So. All right, guys, I put a link down below for the free options workshop. Be sure and grab that. Remember to hit like and subscribe. Leave a comment. Ask a question. Let me know what you're trading. And thanks for watching. I'll see you in the next video.